Just a quick introduction. So my name's Tad Slaff. I'm the co-founder and CEO of Inovance. And really our mission is to help you become a more successful trader. So what I'd like to talk to you today about is how we can leverage machine learning algorithms and artificial intelligence in your own trading. So we're joined today, and one of the other sponsors of the webinar is Core Liquidity Markets, who I'm sure many of you guys are familiar with. And Michael Markarian, who's one of the managing partners, has joined us today as well. We wanted to work with Core Liquidity not only because the liquidity that they provide as well as the execution, but they've really shown that they're dedicated to offering the tools that traders really need to be successful, and providing a lot of support in using those tools. So I can hand it off to Michael here to give you a little bit more intro on them. So Michael?
Thank you, Tad. I'd like to thank everybody for attending today. My name is Michael Markarian. I'll give you a little bit of information about Core Liquidity Markets. Core Liquidity Markets is a global financial services firm. We are registered with the Australian Securities and Investment Commission, which is also known as ASIC. Core Liquidity Markets offers foreign exchange, metals, CFDs, and binary options as our products. Currently, we are partnered with Equinix, and we have data centers in both London, LD4, and in New York, NY4 as well. We currently receive liquidity from over 15 banks, including Tier 1 and non-bank liquidity. Our focus at Core Liquidity Markets is infrastructure and technology. And one of the reasons that we wanted to partner with Inovance, because we saw TRAIDE and the product that they are offering as something that could really revolutionize the Forex industry. And they really have a solid product, and I'll turn it back over to Tad.
Great. Thanks a lot, Michael. So just a quick background on me. I've been studying machine learning and data science and applying those to the financial markets for the last 6 or 7 years now. So what I'd like to go over today, and really the goal of the webinar today, is to give you a brief introduction on what machine learning and artificial intelligence is, how it's applied to the financial markets, specifically when used to build trading systems, as well as give you something actionable that you can actually use when you're building your own trading strategies. You don't necessarily need to be a PhD computer scientist or quant with years of experience to leverage these techniques, and it really sometimes gets a reputation as being incredibly sophisticated and complex. But what I hope to today is show you some techniques that you can actually use. And then once we go over what those techniques, we'll actually put them into practice and show how you can use them to build your own strategy and trade. And what we'll end up with today is a strategy that you can then go use to trade live. So just a quick overview, we'll go over some terminology to make sure we're on the same page, go over the best practices and common pitfalls when leveraging these techniques, and then dive into some specific applications in terms of strategy development, live trading, and optimization, as well as finishing up with building our own strategy and trade. If any of you guys have any questions as we go through this, please feel free to jump in on the microphone or join in, ask a question in chat, and happy to answer any questions you guys have. And then we'll also be sharing this presentation as well as posting the recording of the webinar after that we're done with it. So all this information you'll have access to after we're done. So unless there are any questions now, we can dive right in with some terminology. So I really wanted to make sure that we were on the same page when we talk about artificial intelligence and machine learning. And I know there can be a lot of these are really buzzwords, and there seems to be a lot of uncertainty with what they actually mean. So before we go any farther, I'd like to talk a little bit about how I interpret them and how I define them, and the way that we look at them in Inovance. So first is artificial intelligence. The way that I like to look at it is the study and design of intelligent agents, where an intelligent agent is a system that perceives its environment and takes action to maximize its chance of success. Usually the more common term or way you hear it referred to is trying to emulate the way that a human brain works. But if you look at this definition, that's really saying about the same thing, where us as humans, we take in our environment, usually through our 5 senses, and then try to take action that's going to maximize our chance of success at whatever the task is at hand. So that can be anything from using our eyes and our sense of touch to pick up a glass, to trying to use our own concepts and experience to build our own trading strategy. One other thing I'd like to point out in this definition is the final term, that chance of success. So really what's important with there is that there is an objective criteria. You do have a task that you're trying to perform, and you're trying to be successful at that particular task. So with any artificial intelligence application, it's really important that you keep in mind what that task at hand is, whether it's autonomous driving cars or even trying to fly a drone, anything like that. There's always a very clear success metric. Okay, within artificial intelligence, we have machine learning. So what that means is it's any algorithm that can learn and make predictions on its own without being explicitly programmed. So you can see how this falls within artificial intelligence in the sense that these algorithms take in their environment, usually in the form, or always in the form of data, and then are trying to take action to maximize the chance of success in terms of forming correct predictions. The difference between machine learning algorithms and other more common algorithms is that these algorithms are able to form predictions without being explicitly programmed. So for example, a definition or example of something that is explicitly programmed would be a moving average cross, where you tell the algorithm, okay, I want to buy every time the 10-period moving average crosses above the 50-period moving average. Now this could be a completely valid trading strategy, and it could still definitely an algorithmic trading strategy, but it's not a machine learning component because the machine learning algorithms are able to find out what those relationships are on their own. So for example, it might look at the data and tell you that you should actually look to buy only after the 10-period crosses more than 15 pips above the 50-period moving average. Or it might help tell you should be looking at a 20-period and 75-period moving averages instead of the 10 and 50. But the point is that these algorithms are really good at finding those relationships and those patterns without being explicitly told beforehand what they are. And specifically, when we talk about machine learning and the application with trade, we're talking about pattern recognition. So that's really what it sounds like. It just means we're trying to find patterns in this data. So while we are concerned with that final prediction, we're also very interested in what those patterns that led to make those predictions were. And finally, even though we're not going to be diving into it too much today, I wanted to just talk about big data very briefly. I know it's something we hear a lot of today, but really in terms of the more academic side of things and people who are very familiar with big data is that there needs to be some component of, we call them the 4 V's, sometimes you'll hear it just the 3 V's of big data, for it to be really considered big data. So the one everyone's usually familiar with is volume, meaning there's a huge amount of data. Second is velocity, meaning the data is coming in very fast. Third is variety, meaning that you have different types of data, whether it's categorical, nominal, numeric. And then finally is veracity, meaning that we don't necessarily know if the data is all accurate or if there might be some misprints or some of the data has been corrupted. So usually when people say, oh, I work in big data, they just mean they're working with large data sets. But really, when we talk about big data applications, there needs to be some component of at least 3 or 4 of these different V's for you really to be working in the big data space. So one of our other founders at Inovance put together this little visualization to get a better sense of these terms that we're talking about, where we can see artificial intelligence as a subset of computer science. Within that, we can see machine learning like we discussed, reverse engineering the brain, which is when you hear a lot about the neural networks, where we're trying to emulate how the brain works in order to make more intelligent predictions. And then finally, curated knowledge, which is more focused on understanding exactly a system or a certain data set by using artificial intelligence techniques. Then you can notice that data mining has some overlap with AI and machine learning. The fact that it's not completely in the circle is derived more from data mining is focused on extracting information from data and isn't necessarily as interested in forming predictions or trying to maximize its chance of success with using that information. And then we can see that big data can flow into all of these different techniques, but it is outside really the realm of this, where we can use big data for data mining to extract information. We can use big data with machine learning algorithms to try to uncover patterns, or more broadly, we can use big data and artificial intelligence techniques to really use that information as quote unquote the environment and then maximize the chance of success with any task at hand. So now that we have a brief overview, an idea of what these terms mean, let's talk more specifically about how we can apply artificial intelligence in machine learning to building trading systems. So in my experience, there are really three things that you always want to consider when you're applying any of these techniques. The first one goes to defining success. And like we saw, that was really a core component or part of the definition of artificial intelligence. What are you really trying to achieve? So it's easy to say, well, I want to build a profitable trading system. But it needs to be more in depth with that. If are you willing to accept a profitable trading system if there's huge drawdowns, or maybe you're only returning 5 pips over the next 3 years, so technically it is profitable, but obviously you wouldn't see that as a successful trading system. And in order to be successful, you need to have something that you can track, measure, change, and quantify. Where if you don't know where you're trying to go, there's no way you're going to end up there. So whether you're interested in the risk-adjusted return, maybe you're interested in returning 20 pips a day, whatever that success means to you, that should be driving every single one of the steps in the process of coming up with these trading strategies, especially when you're using machine learning and artificial intelligence techniques. The second thing, and I see this, a lot of people get caught up with trying to build these very sophisticated and complex algorithms or modular systems, when at the end of the day, a much more simplistic, straightforward manner would achieve about the same goal. And it's really, me becoming a data science, machine learning guy, I always get excited about applying the latest techniques or some new library or some new research paper comes out. But it's important to take a step back and say, do I really need to use these techniques to achieve what I've already defined as being successful? Occam razor really applies where, all else being equal, you want to take the method or take the solution that has less assumptions, or usually taken to mean whichever one is more simple. So after you define success, make sure that you are taking the most straightforward route to get there, even if it means not necessarily using AI or machine learning. And finally, with every step that you take, it always needs to be taken with a very strong sense of skepticism. So naturally, as humans, if we run a model or if we perform an experiment and the results are terrible, we're going to really dive in and see if we can figure out what's going wrong. However, if the opposite happens, if we run a strategy or run an experiment and the results are great, we tend to move on and go, awesome, I can't believe that worked so well, let me move on to the next step. But whether your results are good or bad, you really need to be diving down and trying to figure out every step of the way if it was done correctly. Are you confident with these results before moving forward? So while on their own these three ideas seem kind of obvious or not really attached to AI or machine learning, when you are trying to apply these techniques to a real problem, these are incredibly important and definitely have a huge impact on whether or not you're going to be successful. So let's dive into how these are actually applied when looking through the lens of developing strategies. And you can see that all of these are all hyperlinks here, and like I said, I'll share this presentation with you after. But these hyperlinks are going to lead to resources, whether from our site or other sites, that are going to give you very clear step-by-step instructions on how you can apply these to your own trading. Like I said, it's important, and one of the takeaways from this webinar that I hope you get is that you can understand how these applications could actually help you tomorrow when you're going to look to trade. So the first question that a lot of traders have is, what indicators should I use? That's obviously a fundamental question when building any sort of automated strategy, and it's actually an area that's very well researched in the machine learning world. They usually refer it to as feature selection. And there are two general approaches that can be used to help decide what indicators you should look at. The first is using specific indicators that can tell you look at a subset of indicators and tell you which indicator you should be looking for has the strongest relationship with the price move of the asset. And this is it's able to find a lot more meaningful and complex relationships than just looking at a simple correlation. So something like a random forest is not only going to find which indicators lead to the sense of purity, but which indicators are able to classify your data set between bullish and bearish bars the best, but it's also going to tell you which indicator combinations you should be looking for, which, as every trader knows, it's not necessarily how one indicator performs, but it's how multiple indicators, when combined, are going to lead to the best strategy. So using something like a random forest is going to tell you right off the bat which subset of indicators you should be looking for, whether that's comparing an RSI and a CCI, or comparing a 3-period RSI to a 14-period RSI. And these are very powerful techniques that, without a lot of work, you can get a great jumping off point when you're looking to build your own strategy. A slightly more sophisticated approach is using what's known as a wrapper. So basically what that means is we're wrapping indicators around a machine learning algorithm and then comparing different subsets across a wide range of testing data. So once again, the focus of this is to find out which indicator combinations are really going to be the most powerful when used together. But instead of just using a singular algorithm like a random forest, you could wrap it around whatever algorithm you're looking at, whether it's a support vector machine or a neural network. And once again, even though it's good to have a strong conceptual understanding of how these algorithms work, without too much research, you can really give yourself a great jump start when looking at different indicator subsets to use by using different wrappers and looking at the different performance metrics over out of sample or new data. So if you follow that hyperlink, that can give you, some very good instructions on how to get started with that that you can use without needing too much quantitative experience on your end. The next big question, and really what we're focused on at Inovance, is what entry signal should I look for? And this is why I brought up that concept of pattern recognition earlier. So after we've selected our indicators, the next thing that we really need to figure out is when should we look to go long or when we should look to go short. Now, a lot of the more traditional senses of using machine learning or AI in trading tends to be more in an automated approach. So for instance, you would have some algorithm that would take in the most recent piece of data and then make a prediction about whether you should buy or sell. But the great problem with this is that it's a black box, meaning you have no idea why it's making that decision, which is all well and good until the strategy is not working anymore and you really have no idea what happened. But taking more of a pattern recognition approach is we're not necessarily using the algorithms to make that buy or sell decision, but we're using the algorithms to uncover the patterns in the data. Now, this is a much more transparent approach, and then it allows us to use our own experience or interpret those patterns and what makes sense to us, which is another important component to trading. And finally, next thing when you're developing a strategy is you really care about, is this strategy going to perform well in live trading? I'm sure we've all built those back tests that look great when you run a back test, but the second you put it on a live or demo account, the performance tanks. So one of the benefits of coming from the machine learning or data science world is this modeling process, where first you take a training set. So this is the data that you're going to use to build your strategy. So whether you're using an algorithm or you're just analyzing the data yourself, this is where you're going to say, all right, it looks like when the RSI gets above 70, that's overbought and I should sell. Then you take that strategy, and over the test set, which is a completely new data set, you're going to want to compare multiple strategies. So all right, I have an RSI strategy as well as a moving average cross strategy. I'm going to compare it over data that wasn't used to build it to see which one I should choose. And then finally, after you've chosen a strategy, so for example, let's say the RSI strategy performed best, I'm going to then trade it on a validation set, which is data, once again, that wasn't used to build it or test it. And it's a completely new data set. And this will give me a sense of how well it's going to actually trade in a live trading. Excuse me. So this is another technique that even without actually using any machine learning algorithms, it's something you can apply to your own trading. And I see a lot of traders really struggle with this step, where they're pretty much using the entire data set as a training set, and then they're running their strategy over that exact same set. Obviously, it's performing great. But when they go to trade live, the performance tends to tank. But now we have 3 different levels where we're always testing that strategy. We're always taking that skeptical approach, trying to figure out what could be going wrong before we actually move to a live account. Next step after you build a strategy is live trading. An important aspect is knowing when you should turn your strategy on or off. So for example, let's say you build a strategy, it does really well in trending markets, but tends to really underperform when markets get more choppy or volatile. Now, it would make sense that you would want to stop trading your strategy, basically manually turn it off for choppy conditions, and then turn it back on when the market starts to trend more. But the obvious question with that is, how do you know when those market conditions are going to change? And a really powerful machine learning algorithm that does exactly this is known as a hidden Markov model. So what these do is based on your own defined input. So for instance, let's say we want to look at the average true range and the logarithmic returns. This algorithm is able to classify the market into different regimes. Say, regime 1 is low volatility, regime 2 is high volatility, and then tell you when the market is shifting between these different regimes. While this is a very powerful algorithm, this could be one of the applications where a more simplistic approach gets you about 80 to 90% of the way there, where just adding a very simple filter using something like an ATR or ADX is going to get you about the same results. The tricky part there is figuring out the thresholds, but I would recommend, if you do want to explore this, starting off simple and building up complexity. Which again, this hyperlink will give you a pretty clear instructions on how to apply these to your own trading. The next one, and a lot of traders are familiar with this, is trading a portfolio of strategies. But usually this is seen in across assets. So for example, I have a strategy that trades the Euro USD as well as a strategy that trades the Aussie USD. Now, finding out how correlated they are as well as how much exposure to each currency pair you have is a pretty straightforward process. But one of the more powerful techniques from the machine learning world is known as ensemble learning. So what this would entail would be to build a portfolio of strategies that trade a single asset. So for example, you could have 3 or 4 strategies that only trade the Euro USD. And these strategies will look across time frames. Maybe they look at different factors in the market, a volatility strategy versus a trend following strategy. And then when you go to trade, you're combining and looking for validation and verification across strategies before entering in a trade. Now, if these strategies are uncorrelated, that can give you a lot more confidence when you're actually looking to input one of your trades, and hopefully give you a much higher probability of success. And once again, while this really comes from the machine learning world, you don't necessarily need to be using machine learning algorithms to use some of these ensemble techniques. You can combine a couple of very basic strategies and create something that's a lot more robust than any of them on their own. The last point I wanted to make about live trading steps a little bit outside the machine learning and AI world is dealing with these unusual or rare events. So one of the downsides of using these more data-driven approaches is that there are obvious cases where there isn't a lot of data to analyze. Something like a non-farm payroll, you're only going to have tens, maybe 100 or so different data points that you can analyze. that have to do with them. So it becomes really difficult to build a robust model around these certain instances. But what you can do is come up with your own predefined rules or procedures to help deal with them. And I kind of like to think of these as more common sense aspects. And it's important that they are well thought out and tested to the best of your extent, but you need to have some of these checks that you can put in that the algorithms aren't necessarily going to be able to learn on their own. I think a lot of more academic researchers would tend to shun away from these just because they aren't quite as quantitative and they could be a little bit more qualitative depending on your own experiences. But at the end of the day, we want to take a more pragmatic approach, and we're really trying to maximize our own chances of success. And so incorporating these predefined rules or procedures to deal with events that you don't necessarily have a lot of data on is really important. And lastly, a lot of people use machine learning and AI to help optimize or improve the performance of their strategy. One of the big ones is on the risk and money management side. Now, it's very common to look at things like accuracy or return per trade, those certain metrics that are very trader defined. But what you can do to really take that next step is dive into somewhat more of the machine learning side of things when you're evaluating a strategy. So this kind of looks at precision versus recall, whether how many false positives, meaning you're looking for how many good trades do you miss versus how many bad trades do you get into, and other ways to look at the data and the performance of your strategy that are going to give you more insight into the characteristics. So where are the weak points of your strategy? For instance, does it tend to have a really high bias for entering in trades that go large against your direction versus trades that are entering and returning lots of little returns? So if you take a step away from the very trader-defined metrics and start diving into a little bit more of the data science world, you can learn a lot about your strategy, especially how you want to handle your risk and money management approaches. The second area is looking at each individual strategy and trying to figure out, all right, how can I improve the performance? So one of the areas that we really focus on at Inovance is this concept of feature creation. So the idea is that when we look at an indicator such as a simple moving average, we're not just looking at the simple moving average price. What we're really interested in is how far away the current open price is from the SMA, whether the SMA is on a bullish or bearish slope, whether the distance in pips has been increasing or decreasing between the price and the SMA. And so what we want to do when we're using machine learning algorithms is try to give them as much information as possible so that they can make the right decision. And so what that means is instead of just feeding in one of the indicators, the 50-period SMA, you're feeding in the distance in pips between the SMA and the open price. Maybe you're looking at the slope of the line, all this different information that is giving them as much information as possible in a single value. And this is another area where you can really use your own experiences and increase the power of these algorithms in your strategies without needing a whole lot of intense work. It's just, instead of looking at the RSI, maybe you're looking at the slope of the RSI. And something like this can lead to huge impacts on the performance of your strategy. Another interesting topic to discuss is this idea of meta-learners. So when we first talked about the discussion or the definition of machine learning algorithms, we talked about how they looked at data and were able to make predictions basically on their own. But usually when we think of making those predictions, we're looking to predict the direction of the market, and we're looking to predict an increase or decrease in volatility. Another way to look at it is trying to predict the performance of your strategy. So for instance, based on these inputs, do I think this strategy or this next trade is going to be successful? And so what this can tell you is really help with that position sizing. So for example, if you have a meta learner and it's saying, all right, there's a high chance that this next trade is going to be successful, you're naturally going to want to enter in a larger position versus whether one of these meta learners is telling you this next trade doesn't have a high chance of success, in which case you would either scale down the position size or not enter in a trade at all. This is something that's a little heavier on the machine learning side, but once again can really be applied to any strategy, and it can really help turn a fairly okay strategy into something a lot more robust. And the last question you always have is, let's say a strategy starts to have a drawdown. How do you know whether it's actually fallen out of sync of the market or that drawdown is to be expected? So, in the machine learning world, that's talking about the in-sample versus out-of-sample performance. Now, this usually is kind of difficult and tricky to do. Just naturally due to the bias of selecting a strategy, your out-of-sample performance is going to be worse than your in-sample. But what you want to know is, all right, if I lost 7 out of 10 trades, what is the probability of that happening, assuming my strategy is still in sync with the market? So what you want to avoid is either moving a strategy from your portfolio prematurely, or worse, continuing to trade a strategy that's very clearly fallen out of sync. So if we can use some of these more commonly known metrics and techniques from the machine learning world and applying them to your own trading, once again, these fairly straightforward procedures can have a large impact on your performance. So like I mentioned earlier, I'll send off this presentation to you guys after the talk, and you can dive into these resources yourself and start applying to your own trading. But what we can dive into now is how we can apply those same techniques to building our own strategy and trade. So like I mentioned before, our focus at Inovance is to help you become a more profitable or successful trader. So with trade, what we're allowing you to do is easily leverage machine learning algorithms to find patterns and indicators that you use to trade. So this is going to take everything from that machine learning AI algorithms, focusing on the pattern recognition side of things. You're able to use your own features. You're able to easily test in-sample and out-of-sample. We're giving you some more statistics to really know your strategy. But what I'd like to go through today is actually building this strategy live, and then you can see how it's done firsthand, and then even end up with the strategy at the end of the day. So I'll bring this up, bring up trade here. So once again, this is a cloud-based platform. I'll send you the link to create your own account after the webinar. And if you do have a core liquidity account or you do open an account after the webinar, you'll get access to not only the live trade quant fund, but we'll give you the live strategies that we are trading on our own. Once again, we are using trade to trade our own account, and we'd like to show you, how we're doing it, so hopefully you can apply those same techniques to your own trading. But let's go through the process here of creating a new strategy. So once we log in, you can see some of the strategies that we've built before. But let's create a new strategy here. Give it webinar strat 1. Select the asset we want to trade. So you can see here we have a wide selection of currency pairs. We have 3,000 most traded U.S. equities. But let's keep it simple with an FX strategy, and then build those on daily bars. Just from our own experiences, we tend to see better strategies and more and stronger signals on longer time frames. If you look something at 1 hour or even below that, it tends to be really noisy. So building something on a daily time frame or even 4 or 6 hours greatly increases, we found, the robustness of these strategies. Obviously, that's going to depend on your own profile as a trader, whether you like to, whether it's okay with you that it trades only a couple times a month versus wanting to see a trade enter in every day. But at the end of the day, I think it's, over trading is a serious concern, and trading something that's going to perform well over a longer period of time should be the primary concern. Okay, the next we'll choose, like we talked about earlier, this is our training set. So this is going to be the data that we use to build our strategies. There are 2 things that you want to consider when choosing your training set. So one, you want to make sure there's enough data to really give the algorithms the information they need to uncover those meaningful signals. And second, you want the data to include a wide variety of market conditions. So for example, if you're training your data over huge bullish trends, obviously it's going to, that's the only information it has. and it's going to have a lot of difficulty picking up on any bearish trends or sideways markets. So in this case, looking over the last 5 years of data should not only give us enough data, but will also give us a variety of market conditions. And most importantly is that it still gives us a whole year of data that we can then test our strategy before going on to the validation set, which we like to use paper trading. Once again, the main reason behind that is we want to be sure that the signals that are picking up are actually going to hold up over live trading and aren't just specific or unique to this trading set. So now that we have our asset, time frame, and the date range, we're going to choose the indicators that we want to use for our own entry signals. So this is really the area where you can use your own experience or do your analysis outside the platform. I have found success in building my strategies when using a variety of time frames and trying to find indicators that aren't calculated the same way, or very low correlation. What you want to do is give these algorithms as much unique information as possible. So for this strategy, and this is something where one of the benefits of trade is it's really easy to iterate through these and test a lot of different combinations. In this strategy, for example, it took me a couple hours to really find these combinations of indicators that worked out well. So trade provides some fundamental data, whether you're interested in looking at the price of oil, maybe you're interested in federal funds rate, or even in looking at fundamental data more focused on the U.S. markets. But for this example, we'll just go through a basic technical indicator strategy. So the first thing that I want to look at is the direction of the trends. Like I mentioned before, I'm not really interested in just where the simple moving average line is. What I really care about is where it is relative to the current price. So what we're going to do is the price minus the SMA is feeding the algorithm the number of pips difference between the open price and the simple moving average. So hopefully what that'll tell us is when that price is a significant number of pips above the SMA, we're in a strong bullish trend. When it gets close to the SMA line, probably not that strong of a trend. And when it gets far below, we tend to think of that as a bearish trend. But one of the advantages of trade is that instead of us explicitly telling the strategy when to go long, when to go short, we're taking a much more data-driven approach, where we're allowing the algorithms with no biases moving into it to see what patterns it's actually able to find. So we'll choose that as our first indicator. Then the second indicator that I really like using is what we call a min-max ratio. So basically what this is looking at is where is the current price relative to the min-max range, in this case over the last 7 periods. So this is the percentile. So 0 through 10 would mean that it's in the bottom 10% of that min-max range. 90% would be in the 90th percentile, so the upper channel of the range. And then finally, I want to look at a 3-period rate of change. So the rate of change is just looking at the current price compared to the price 3 periods ago. And what this will do is give us a sense of what direction the market is moving over the last 3 days. So I like this strategy because, one, we're taking into account the overall longer trend by looking at what the price is compared to a 50-period or a 50-day moving average. 2, we're looking at just the last 7-period rolling windows to see where the price is in its most recent range. And 3, we're getting a sense of, all right, where's the market been moving recently? How fast is it moving over the last 3 days by looking at the ROC. And so now, instead of me bringing up these 3 indicators on a chart and trying to look at the 1,000 data points over the last 5 years and find the relationship between them and the price movement of the Aussie USD, we're letting trades algorithms do that analysis for us. So once again, these are machine learning algorithms used in a pattern recognition approach. So click Analyze, let the analysis run, and then you can see exactly what patterns they were able to find. So on the right here, we can see the indicator plotted out over the last 200 points. So we just see the min-max ratio ranging between 0 and 100. And then for each data point, we can see whether the resultant bar closed up or down. We can see here that in this particular case, when the price was in that, looks like about the bottom 10 percentile, that bar closed up. And what the histogram on the left is showing is the same. Now the indicator values are set out on the x-axis. And then we can see for each range of indicator values how many bars closed up versus how many bars closed down. So for example, we can see here that when the SMA, or when the max ratio was between -5 and 5, that we had 43 bars close up and 37 bars close down. And then to go long, to build our rules to our strategy, we're going to look for where TRAIDE's algorithms were able to find the strongest signal. So we can see here that it found a particularly strong signal when the min-max ratio is between -5 and 5. And then we're just going to build our strategy directly off these histograms. So if you notice when I click that chart, we can see the equity curve plotted here on the right. So all right, let's say every time I'd gone long when these conditions were met, how well my strategy would have performed. And what we're able to do, if you notice when we select the rules on the first indicator, the patterns in the ROC change. So now what it's showing us is when the min-max ratio is between -5 and 5, what patterns emerged in the rate of change. And so like we talked about earlier, this allows us to find the relationship between, we're not looking at each indicator on its own, but now we're looking at the indicator in combination, in relationship to each other. And this allows us to find those patterns in the data that aren't going to be obvious if you're just looking at each indicator in isolation. And what these machine learning algorithms are really good at is finding out these hidden relationships that aren't immediately obvious. So now if we focus on the second indicator, you can see that the ROC found a really strong pattern here when it was between -1.8 and -0.59. And we're going to want to continue to build our strategy just like that. Take a look at the price minus the SMA. And once again, looking for strong signals, as well as when there was more bars that closed up and closed down. So you can see here, I'm just looking for dark green bars, as well as where the green bar is taller than the red bar. What's interesting here is that we can see when the price is between 78 pips below all the way up to 390 pips above, we would look to go long. But then also when the price is 700 pips below the 50-period SMA, that was actually another really strong long opportunity. So before we move on, let's just take a look at what these long conditions are really telling us. So we can see that we want to look to go long when the price is in the bottom 15 percentile of the 7-day range. We want to look to go long when the last 3 periods have actually been negative going down. And we want to look to go long when the price is between 700 and 290 pips below the 50-period SMA. So it looks like we've built a pretty strong counter trend following strategy. And then we can also notice that there is another long opportunity when the price is crossed above the 50-period SMA. And basically we're saying we're not looking to go long when it's a little bit below, which makes sense conceptually because when the price has crossed more than 100 pips below the period SMA but hasn't quite gotten to that 400 range yet, that's usually the sign of a pretty strong bearish trend. So then let's go and repeat that process except look to go short. And we can see that the counter trend properties still hold up for our short signals. So meaning we're going to look to go short when the price is in the upper 75% of the 7-day range. We'll see what patterns we can find here in the SMA. We see 2 strong signals here. And the price is between 78 pips below all the way up to 230 pips above. It is interesting here, even though it wasn't able to find a strong signal, we can test to see whether we want to go long. And just looking at our equity curve, you can see that performance really dips when we add those rules. So I'm going to leave that out. For this case, we can test when the price gets pretty far above. Once again, it doesn't really give us a whole lot of increase in performance, so I'm going to leave that out. And then we'll finally add the rules to our ROC. Those conditions, see what happens when we add this. We're getting a little bit stronger. I'm going to keep that out for now. And then go back to check what prices we see in the min-max. Keep this out here. And just like that, we have the rules to our strategy. So let me just go double check everything on the long side. So we got some strong signals here. I'm going to leave these out for now just because it's not a huge sample size, but that's definitely something that you would, at your own discretion, potentially want to include in your strategy. But in this case, This looks like a pretty smooth equity curve. You can see that both the long and short rules tend to perform about this as well, which is nice to see. You don't want a lot of your returns coming from only the long side or only the short side. It's pretty smooth, overall equity curve from left to right. Decent overall return. You can explore some more stats here. I always like to look at the return per trade, trade accuracy, the volatility, Sharpe ratio, all of that. Change the deposit position size if you like. We want to look at the trades written out. You see that here. And then even if you want some more information on the machine learning algorithm side, you can see that we used a Ripper rule learner. Here's a brief description of what that algorithm actually does. And then across the entire data set, you can see how well the algorithm performed. Now, while we're primarily concerned with individual rules, so for instance, how well did it perform in this range, it's always nice to get a sense of, okay, if you take a 3,000-foot view, how well did this algorithm do? And we can see here that it was over 50% accurate, which gives me some confidence that these indicators are worth exploring. So now that we've built our strategy over the training set, obviously the next question is, we want to test it over new data. And what we can do in Trade is we can actually generate the code for MetaTrader 4 EA. So what we're doing is translating these rules into an expert advisor. Now what's great about this, you don't need any programming experience on your own, and it makes it really easy to take this strategy and move it to your MetaTrader 4 terminal, both for testing and trading live. And with Trade, what we're also providing is an indicator library. So you can be confident that the indicators that we're using in Trade are going to be the same that you use in MetaTrader. This is using an open source indicator library known as TALib. And if you do download it and run your MetaTrader, you can use it with or without Trade. So if you're interested in how doing that, first time you're going to want a very easy installation process, and we're happy to help you out with any questions. But for the sake of time, let's just go and generate our own EA. So what I can see here is the EA code is all open source. What I do is download it to my desktop, and then bring up my MetaTrader 4 terminal. So this is the core liquidity MetaTrader 4. I always want to be sure that the data that I'm testing on is going to be about the same as the data that I use to trade live. So let's open up that EA that we just saved. Should be on my desktop here. Open our strat 1. Got it. Make sure it compiles, and then move over to the terminal. So like we said, the strategy was built all the way up until January 1st, 2015. So what we're going to want to do now is run it from January 2015 up until today. And what that is going to do is what we're going to look for is we want about the same performance of that strategy in sample that we saw in Trade. So for instance, we're interested in looking at the stats page, somewhere around 63% accuracy. We want that return per trade to be around $8 or $9. Basically, we're looking for consistency, meaning that the strategy performed just as well in the in sample as out of sample. And that gives us a lot of confidence that this is something that's robust enough to handle a variety of different market conditions. So we can open up the expert properties. Make sure we got the right strategy here. Open our strat 1. Take the inputs. So bar close is the way that trade runs, meaning the trade is exited at the close of the bar when the conditions are no longer met, or if there's a signal in the opposite direction. We can change our position size, maximum slippage, all of that fun stuff, or add a trailing stop. But for this case, let's just run it as is and see how well it does over this last year of data. So like we talked about earlier, we talked about using a training, test, and validation set. So we already saw what our training set was in Trade. This is our test set that we're now running for over the last year. And what we use for our own validation set is then we paper trade it for a month. So that gives us a whole other level of check to make sure that this strategy is actually going to be performing well live. And so assuming that this looks good for the out of sample test, then we're going to actually want to go run this on a demo account And once we can verify that it's performing well on that demo account over live data, then we're going to move it to that live account. So once this backtest is done, we can see how well it does. A minute here. If anyone has any questions or runs into any issues running these backtests, be sure to just reach out to us. There are some very MetaTrader 4 specific things that must be done before running these. So if we just look at the report here, two things jump out immediately. So we can look at the graph. Looks like not a great equity curve, which initially can be a little disappointing, meaning that, all right, well, our strategy didn't return very much over that date range. But if we dive down a little bit into the data, one thing jumps out immediately in that it was, got 2/3 of the trades correct, meaning it was 67% accurate. And really what killed us was that it being a counter trend strategy is that when it got it wrong, the trade tended to run pretty far in the opposite direction, whereas when it got it right, there wasn't a huge return on an average trade basis. So what we can do now is to take advantage of that high accuracy is add a take profit and stop loss. As we mentioned, the risk and money management is incredibly important. So if we go back here, we just add a very simple 100 pip stop loss, 100 pip take profit. I like to keep the 1-to-1 risk rewards ratio in this case, just because we can hopefully take advantage of some of that high accuracy. And then boom, we're going to run it again and see how well it does now adding that risk and money management. And try that out. And then once again, this is another part of the testing system where we're adding those risk and money management parameters on top of it before going and running it on a live account. Wait for this backtest to run. If you want to add a trailing stop, you're free to as well. I tend to feel kind of ambivalent about it either way. Sometimes with a counter trend strategy, it's not great. Trailing stops tend to do a little bit better in more trend following strategies because you can lock in profits getting in early on the trend. But that's really up to your discretion on what you want to do and add to your strategy. So once we see that this is running, hopefully we can get a little bit better performance here. All right, so that's done. Go to our graph, and we can see much better. There was a little bit of a drawdown in the beginning, but a really nice smooth upward trend moving on from there. We can see that our accuracy actually went up. So at 68% accurate, the average loss per trade is still a little bit bigger, but at least we were able to cut off all the losses at 100 pips. And nice total net profit. We can see our exit payoff is actually better than what we saw in the in-sample test. So I'd say that this strategy passes the training set. And what we're going to want to do now, swing up, chart the Aussie USD, like that daily chart. And then we're going to add this strategy and taper trade it. So it's just the demo account. I'm going to set those risk and money management parameters that we talked about earlier. So 100 pip take profit, 100 pip stop loss. And then boom, just like that. We're actually already in a trade, interesting enough. So hopefully this one works out. But what we're going to do is run this on a demo account for the next 2 weeks or so, just to make sure that the performance is holding up as well as we expected, both in the training and in-sample test. So if we take a step back and look at what that whole process was we started out with the theory that, all right, I think these indicators could provide some insight or could form the basis of a profitable strategy. We used machine learning algorithms to uncover patterns in these indicators, as we can see here on trade. And then we were able to dive down into those patterns to build our own rule. We have 3 different levels of checks to make sure that the strategy can perform well in live trading. And that whole process, I mean, it's been an hour since we started the webinar, but really the strategy creation process was just in the last 20 minutes or so. We were able to go from just an initial idea to, here we go, a fully automated expert advisor that's now ready to trade live, assuming that it performs well with this two week or so test. And so what you can do is if you do have an account with Core Liquidity, or if you do open an account with those guys, and we can send that information over, and I'm sure Michael will be more than happy answering your questions, is that'll give you access to all of the strategies that we're trading live as well as access to the Trade Quant Fund, which is our own live strategy that we're running. And I'll send off the strategy that we built today so you can play around with it. I'd really encourage you to try the strategies yourself, go through this process and see what you can come up with, either building off your own strategies or trying something new. And that kind of wraps it up. I'm definitely going to hang around for some questions if anyone